Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in an hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The Trump administration is threatening to indict federal U.S. Reserve Chair Jerome Powell. The Department of Justice investigating congressional testimony he gave last summer about a building renovation. But the U.S. president has before lashed out at Jerome Powell for not lowering interest rates. In fact, he's publicly raised the idea of firing him. The chair says this is a pretext to gain more influence over the central bank and monetary policy.
No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people.
Shares of Lululemon moving higher today after the retailer shared it expects fourth quarter sales to come in at the higher end of guidance. Revenue is expected to top $3.5 billion U.S. thanks to stronger holiday sales. Lulu's founder and Elliott Investment Management are pushing for changes and new board members at the company. The CEO will be stepping down at the end of the month. U.S. bank stock seeing some pressure today after Trump called for a one-year cap of 10% on credit card interest rates. Trump says it would take effect January 20th, but American lawmakers say the move would require the approval of Congress. A joint statement from 5 lenders says the cap would reduce credit availability and be devastating for millions of Americans. Shares of Warner Brothers edging lower today after Paramount escalated its months-long bidding war. Paramount has filed now a lawsuit against Warner to force out more details about Netflix's takeover agreement, claiming Warner failed to provide proper disclosure to shareholders. Paramount also plans to nominate directors to the Warner board and propose an amendment to Warner's bylaws. Warner called Paramount's lawsuit meritless and says it has yet to address deficiencies of its offer. The TSX set for a new record close. It's at 38,871 right now, up 258 points, or 0.8%. The U.S. market started out the day slow, but have moved up. The S&P 500 17-point move. Dow Jones a 59-point gain, or 0.1%, and the Nasdaq 125-point move up, about 0.5%. So again, the TSX hitting another record high on the day. The S&P has reached another record high, despite that investigation into the U.S. Federal Reserve Chair Jerome Powell. So how do we interpret this? Let's go to Brooke Thackeray, research analyst at Global X, for some more insight. Brooke, thanks for joining us today.
Thank you.
How do you read this move by the S&P on the heels of the news about Powell?
Well, we're still looking at the financials being down, but some parts of the market being down. But overall, the market's rebounded a fair bit. I mean, the big concern is obviously the independence with the Federal Reserve, but the market's taking it in stride here. And, maybe they're saying, well, you know what? Yes, this is not a good thing, but perhaps this won't come to fruition. It's going to be very difficult for this to take place. And there's going to be a lot of pushback on it. I think this is more of a threat. And I think maybe that's the way the market's seeing this at this point. It's like Trump just trying to bully the Federal Reserve to say, look, I'm in control for the next person coming in and everybody else. So at this point, it's the market's sort of just taking it in stride, doesn't know what to do with it, and they're not really pushing the market down on that.
Okay. You think there is enough good reason then to shrug it off? Do you think it's fair to shrug it off this way? You mentioned you think it's just a threat.
I think in the end, I think there's going to be enough pushback. Will Powell get indicted? I don't know all the details of what the claims are around the renovations and all of that. I don't know. But it's going to be hard to really push that forward. The standard's going to be really high to actually indict Powell on something like that. So I'm not sure that this will actually proceed much further. There's a lot of talk and whatnot, but I think this might be just a scare tactic. And also the markets might be going, well, you know what, we like lower interest rates. Like they like certainty and stability, but they also like lower interest rates as well. So I think the market's just saying, well, we'll just wait and see at this point.
Okay. As you mentioned, financials still off with Donald Trump talking about capping interest rates on credit cards. First, what would the fallout of that be? As you heard, some of the letters are saying that means a lot of people won't have the option of a credit card.
Yeah, I mean, the end result is not very good. You find that a lot of consumers will have their credit cards taken away from them very quickly because the credit card companies and the banks need to be compensated for that risk, of people not paying. So they have higher interest rates. That's the way it works. Now, we see them as being really high. Maybe they are too high. But take them down to 10%, that means the banks have to start really clamping down, which means they're taking money out of the system as well. And it's going to force consumers to go to other organizations such as payday loans, which are going to charge even higher interest rates. Or, there might be some online Klarna type of buy now, pay later options as well. But overall, this has a negative impact for everybody. This is not the way to do it. I'm surprised that they're actually trying to launch this far out from the midterm election, because this is really a midterm election type of thing. Look, I want to lower interest rates for everybody. And this is another one. I'm not sure this will actually get done. I mean, so January 20th is just around the corner. This isn't like the tariffs. Right now the Supreme Court's going to rule about the tariffs being legal or not, probably on Wednesday. But Trump was able to push those tariffs through to enact them, legal or not, because he controlled the borders and the ports and the border guards. In this case, it's the banks, and Congress needs to pass the law. So it's generally accepted that Trump doesn't have the power to just force the banks to do it. The banks don't work for the government, so he can't really force them. And they'd have to be doing this voluntarily at this point. So this is going to be a really interesting situation. I don't think this goes through at 10%. Maybe the banks come back and go, okay, we'll lower our rates a bit and come up with some other plans. But I don't see this one happening here. Okay,
so you see this perhaps as the start of a negotiation. And we know Donald Trump likes to do that, come out big and then have the back and forth.
Absolutely, yeah. I mean, that's the way I see it exactly. He wants the banks to come back and say, look, we'll give you something just to get off our backs here. But I think this is just a start. I don't think they're going to be 10%.
Okay, let's talk about Shopify for a moment. It's working to give consumers sort of AI on Google to be able to shop. So how will this work?
Yeah, so this is really an agentic experience. So this is, if you think about it, it's the beachhead to get the agentic experience, like an agent acting on your behalf into the marketplace for consumers. And it's a great way to do it. It's just like when we go to tokenization, they'll probably do it with real estate first. There's some applications that make sense to start. And shopping makes sense to start with this type of approach. And so what they're trying to do is to try to create this experience where this agent really checks everything for you, applies coupon codes, compares prices, all the way to actually making the purchases. And this is a really interesting approach because it's a great approach for Google and for Shopify as well, because then they actually start to control more of that wallet through the agent, which is the byproduct of that. But they're trying to make this to be a fast, easy, efficient process for people checking out and provide them other value benefits, such as better comparisons with other products and prices.
Yeah, it'll be interesting to see how much they pack on to a Google platform, because it'll change Google, right? Not just from a search engine, but to a buying platform and possibly so many other things.
Well, the world's moving towards some sort of digital money down the road, probably, and tokenization. And so these companies are all in a fight for it. And this might be the beachhead to do that, when you start to control some of that. And you want a piece of that pie and how consumers spend, and to be able to help control that spending. If you create the agent that does that, you're going to have some control. I mean, they're obviously not the ones behind putting out the money themselves or the tokens or whatever, but it does give them a more immersive experience into that world, and helps for them to prepare for the future for AI to be used in not only shopping, but other experiences as well down the road.
Okay, I'm going to leave it there, Brooke, but thank you very much for joining us. Appreciate that.
Thank you very much.
And coming up, we'll dive further into Trump's threats to indict the U.S. Federal Reserve Chair Jerome Powell. Back in a moment. The U.S. dollar slipped and gold rose after the Trump administration threatened to indict the U.S. Federal Reserve Chair, Jerome Powell. The Bank of Canada's governor and former U.S. Fed chairs have expressed their support for him. Let's break it down with Alex Moore, CEO, CIO, FM Investments. Alex, as you know, later this afternoon, the market seemed to have shrugged this off. They don't seem to mind as much anymore, the S&P getting to new heights. What's your take on this?
I think much like the markets now, last night, everyone, myself included, had a bit of a running around yelling, very loudly. And we've settled into a bit of a meh sort of response to this. The president's threats to do these things, although quite serious, subpoenas coming to the Eccles building and being told a criminal investigation is being opened into you, are a far cry from what they used to be, in the sense that the president has shown a willingness to politicize these otherwise very simple, very, reasonable processes to his whim, right? We're seeing that Trumpian vengeance is very real and unbounded, certainly in the president's quest to find loyalty in the Federal Reserve and the Eccles building. But let's also not forget, and I think the market is taking this into account, this is Jay's first real plea for more support, and he's getting it from the Senate. And Senator Tillis and Murkowski have made very clear that they can gump the works and probably will until this is stopped. From the Supreme Court, who went out of their way to speak about the independence of the Fed and its ability to do its job in prior opinions, and their likeliness to overthrow tariffs in the coming, and willingness to hear out Governor Cook. So the expanding of the aperture here for the Federal Reserve, its independence, and Jay Powell in particular, individually, has it really opened. And the market is realizing we're a long way away from anything happening. And we didn't learn anything new today other than the president politicized a process that used to be sacrosanct, but sadly, there's nothing new about that.
Okay, that being said, for investors who are outside of the U.S., what kind of message does it send about the independence of the Fed and whether that's a concern?
I think the Fed's independence has long held this mythical status as if it was truly independent. But over time, it started off independent, and that independence has been eroded through political process over the handful of financial crises that the Fed has endured. And today, there are folks who are political in nature on the Fed board. We've seen the willingness of the Senate confirmation process to gum up the works to make sure that a sitting president gets the folks that he wants on there and delay the opportunity for folks who may be hostile to current policy to be there. So from a foreign perspective looking in, I think you're seeing the erosion of independence, but probably recognizing that a good chunk of that had been eroded long ago. And what remains now is a relatively hostile executive branch. But for the first time in a long time, we're starting to see a retrenchment from the Fed and from the folks who the Fed works for, Congress, to defend that independence.
Okay, so we know Jerome Powell's time is almost up. He doesn't have much longer of a term. We know Donald Trump wants to put a stamp on whoever goes in, a rubber stamp from him. So what does the next Fed chair look like? And will there be concerns about independence moving forward? Or do you think Americans and investors are just going to go, okay, yeah, this is what we expected. We've already worked this out?
Well, I think the market is certainly expecting someone named Kevin to do it, with maybe an offside chance of someone named Scott. But odds are pretty good it's going to be a Kevin. War seems to have taken the lead from Kevin Hassett, but it is clear this is a message to the next Fed governor directly from the president: do my bidding as I ask for it. And the president has expressed his disdain for reappointing Jay, who he felt didn't live up to his promise of what the president thought he was getting, a toady in the Eccles building. That didn't happen.
Do you have concerns about inflation moving forward if you have someone in the chair's place who's just going to do what Donald Trump wants at that moment?
I do, and I think investors should. I think that the board itself has made clear it has concerns about about inflation, both from tariffs and what that might do, from just general policy and what that is doing today and what that looks like.
Okay, we've seen a move to gold last year with Donald Trump's first year in office and the volatility of that year. We're seeing that already happen in the start of this year, of course, with threats to Greenland and the incursion in Venezuela. Do you expect more of this to run out this year?
I think there'll be more volatility. There'll be more political and markets noise that get entered from this. We're going to get a really interesting signal in May. Jay Powell will no longer be the chair, but his governorship continues into 2028. Almost all chairs have left early when that has happened. But given what just happened, we may see Jerome Powell stick around as the last fire break for true Fed independence, and which might actually serve to dampen some of the noise that and some of the rush to these inflation and anti-inflationary securities that you're seeing today.
Okay, but how much power or authority will he have if he's not lead in that group, but he just remains on for the extra 2 years?
He has a very critical role. If he were to leave in May, the president would be able to appoint someone to his seat, which would give the executive branch majority of the Board of Governors. That majority would allow them to hire and fire regional Fed presidents, and therefore the makeup of the FOMC, which sets rate policy, more or less at their will, and fill it up with courtiers that are willing to enact policy that probably is not helpful for inflation or for what the Fed has been working on the last 2 to 3 years. So he could be that critical turn vote, which might be a role that at this point, Chairman Powell feels he needs to take.
Okay, I'm going to leave it there. Alex, thank you very much for joining us. Alex Moore, CEO, CIO, FM Investments. Coming up, Lululemon recently hinted at stronger holiday sales. The brand's forecast come despite a number of changes in the future for this brand. We're back in a moment with that. Lululemon says it had a good Christmas. The athletic wear retailer announced it expects its Q4 net revenue to come in at the high end of its guidance. Let's unpack with David Schwartz, senior equity analyst at Morningstar. Thanks for joining us today.
Thank you.
So Lulu, a gainer today on the market. What led to this sort of rosier outlook for the company? Just good Christmas sales?
We weren't given a lot of details at all today in today's press release. It was really just a holiday sales update. There's still more than half a month left in the quarter, so we'll have to see how that goes. But Lululemon is having some meetings with investors this week at an investment conference and wanted to give an update. And the update was that the numbers were coming in at the high end of the guidance we were given back at the last earnings report, which realistically is not surprising at all because Lululemon, even in difficult periods, tends to outperform estimates and guidance. And in fact, the numbers this morning pretty much match up exactly with what I had forecast for the quarter. So, and I think that's probably the case for most analysts, that they were already at the high end of the guidance. We weren't given much detail, but I do believe that the Americas revenue is still going to be down in the quarter, and that's what's in my model. And so Lululemon still is not really doing very well, but that's not a surprise at this point because it's in a transition period. The company is selling some of its older merchandise to make room for newer stuff that's coming out in 2026 as the year goes along. And Lululemon is also right now going through a CEO change. Longtime CEO Calvin McDonald is leaving the company at the end of the month, and we do not know yet who will be his replacement. And so there's a lot of things going on at Lululemon, and right now the company is not performing at its best, but I still think that there's a lot of potential here, and I think the stock is undervalued. My fair value estimate is $295 per share. So I think that Lululemon is on the track of a turnaround, but it's still a ways away at this point.
Okay, you mentioned that they have not been doing as well in the North American market. Why is that? What has dragged them down here?
Lululemon's really been struggling the last couple years with competition from some newer competitors like Vuori and Alo Yoga, as well as others that are out there and have been out there for a long time that are really getting more into women's athleisure. And so the competition has affected Lululemon. There have also been some internal problems at the company. It lost its chief product designer about a year and a half ago. She left to run Vans. I think that hurt Lululemon. The company's had trouble at times getting the right merchandise in the stores. There have been issues with the colors of the products and even the sizes. There have been times when Lululemon sold out of certain sizes, and that really disappointed customers. And that's not normal for Lululemon, which historically has been a very strong operator. But we have seen some problems, especially in North America. But realistically, that was somewhat inevitable because at this point, Lululemon has stores in every major metropolitan area in the U.S. and Canada. And so there just aren't as many places anymore for Lululemon to grow domestically. So a lot of the growth is really going to come from the international markets, especially China, which is where Lululemon is really opening most of its stores right now. So I do think that the company has growth prospects in North America as it tries to build more of its men's business and also expand into categories like footwear. But right now it is kind of struggling in that market.
Okay, you mentioned the leadership race that would be underway. What kind of person do you think the company needs to move it ahead? I know that the Elliott firm wants a certain person in with a certain background, but who do you think they need?
Yeah, and so the candidate that Elliott seems to be pushing is a woman named Jane Nielsen, who was the CFO at Ralph Lauren and was very successful there. She would have the kind of background that Lululemon is looking for, someone with a strong background in the apparel market, someone with a background in retail, someone with international experience, because so much of the growth is going to come from outside of North America. And so, she would be one strong candidate, but there are others out there too. I think the Lululemon job is very attractive. And there's a lot of strong CEO candidates that would probably want the job because this is still a very strong retailer, generates huge cash flow. It's still the leader really in women's athleisure with a very strong brand name. Despite the recent problems, I don't think that Lululemon has lost its popularity. I think that their core customers are hoping to see more new stuff. And I think that's been probably the problem over the last couple of years is that there just hasn't been enough innovation in terms of product attractiveness. And, I think that can be changed under new CEO, and there'll be a lot of interest in that job.
So you see the biggest challenge then as getting a merchandise out there that catches the attention, especially of North American consumers?
Yeah, I think so. I think what's been happening is that a lot of the core customers have been going to Lululemon stores and they've been seeing too much of the same thing. They've been seeing sort of the same products that Lululemon's been selling for years, but maybe just in different colors. Now, I think there is an interest in seeing some new merchandise. We did see this about 2 or 3 years ago when Lululemon really got stronger in accessories, and some of their products like crossbody bags were big sellers. And I think that's more of what their core customers are looking for. They're looking for something different, and that could be footwear, but it also could be apparel and accessories as well.
Okay, David Schwartz, I'm going to leave it there. Thank you very much for sharing your time.
Thanks.
Coming up next, markets reaching all-time highs as investors anticipate another strong earnings season. Back in a moment. Gold on another tear today. Metal stocks big movers on the TSX. To discuss an outlook for Canadian equities in 2026, we go to Darren Donselrud, Chief Executive Officer at QV Investors. Thanks for joining us today.
Thanks for having me today.
Is gold overbought?
Well, I think, as some people would say that, but I think what we've seen in the markets these days are individuals looking at gold as a place to put money because they're not sure what's going to happen with the US dollar. So I would say if you look at some of the shorter term technicals, it looks overbought, but I think you're seeing multiple people in the markets stating that gold can go higher. One thing here at QV we don't try to do is predict where commodity prices are going because it's quite difficult. But I think just as we're seeing, and you talked about recently or earlier on the show, talking about what's happening at the Fed, potentially you could get people concerned about the interest rates going down. US dollar would then go down and people looking for an alternative, and that could be gold.
You mentioned that you don't look ahead to how much a stock could gain, for example, but because of the uncertainty at the start of the year that we've seen and heard about already, do you think that could sustain a run for 2026 for gold?
I think it could sustain a run. I think the one thing that somebody could do is look at gold as an alternative to some of the other asset classes out there. I think the big risk, though, is the big move that it has had. I think when somebody's developing a portfolio, looking at a variety of different asset classes, so rather than selecting gold as a main component, gold may be a piece of it, but looking at some of the other alternative stocks out there, and we're seeing some attractive opportunities in Canada, especially in small cap, but also seeing it in global markets ex the US, just because we have seen a big valuation change upwards in the US.
So gold has given the TSX a lift in 2025. How would you describe the broader market right now?
I would say the broader market, when we take a look at the returns, so in Canada last year, we had a 31% return. About 11% of that, by some calculations I've seen, has been a result of valuation expansion. So not earnings per share growth, but value expansion. So that's a pretty significant component. So last year, what we saw is the TSX catch up in terms of valuation to the US, not to the same level. It's still trading below. But I think what we have to do is just be more careful as investors as to where we select, what sectors we select investments. So those that are not trading at all-time high valuations. When we take a look at some sectors, and an example I'll use is grocery stores, we see Loblaws trading at 27 times price earnings at a very high level compared to where it's historically traded. So there are some areas that we need to be cautious about. So there's opportunities. One that we would talk about today is the transportation. We're seeing some weakness there, very high quality businesses. That we think people can take opportunity of. And I'm speaking about Transforce, CN, CP Rail as examples.
Okay. We have the PM heading to China. As you know, electric vehicles will likely be up for discussion. Do you expect much movement there? Ontario, we know, has a base of manufacturing for a lot of autos. They don't want to see a tariff lifted on Chinese EVs. So do you expect much out of those conversations?
Well, I think the main thing that we should think about is we are seeing a PM of Canada go there after a pretty long hiatus. So I think the important thing is we have the PM going, Mr. Carney, going to China to start those discussions. And I think the biggest component is, what exactly is going to be said and what's going to be agreed upon, we're not sure at this point. But I think we are interested in some sort of deal that allows some of our farm products to be exported. And there may be some concessions that need to be made, whether it's on EVs or whether it's other parts of our market. I think a negotiation would be beneficial to Canada, and I would assume that's what Mr. Carney is looking at.
All right, let's get to one or two of your stock picks. National Bank is one you like. Will financials, you think, do well this year, and why this one?
So I think the biggest thing that we've talked about here at QV is just valuations have been moving up, as I mentioned before, in the whole market, but especially so in financials. What we do have, though, is an advantage in a company like National Bank. It has lots of capital. We've seen it actually use that capital in buying some Laurentian Bank portfolios. That put some of that capital to work. What we've also seen is them make the acquisition of Canadian Western Bank that has allowed them to use some of their capital, but also provide revenue synergies and cost synergies. So right now, the CWB acquisition has allowed them to gain a significant amount of synergies. And in their latest result, they stated that they expect 200 to 250 million of revenue synergies. That was the first time they came out with that number. So for a company like National Bank, we do still think there's opportunity going forward.
Okay. You like WSP Global as well, which is an engineering company. I guess they also do the actual building or construction. Tell me a little bit more about why WSP is a pick for you.
So for WSP and engineering companies in general, what we like about them is we are seeing a lot of projects. We've talked about over the last year, all the number of projects that are being fast-tracked. I think they will have an advantage there in Canada, but also in other countries. They're very cash flow generative. Not a lot of capital is required because this is a people business. And what we've also seen is the organic growth at WSP has been mid-single digits. And then we also have acquisitions. So recently they announced an acquisition of TRC companies, 3.3 billion US acquisition, which would also give them growth. And so over the last little while, we've actually seen the organic growth of mid-single digits, as I said, but then also growth on the inorganic with their acquisition that has led to meaningful organic growth going forward. And what we've seen over the last 5 years, the company is kind of moving back and forth, some organic, some inorganic, but overall we've seen very strong earnings growth. And we've also seen, with the number of people they're adding with these acquisitions, the cost per employee is coming down, so the margins are actually increasing. So their operating margins are sitting around 14, 15%, which are very high levels and continue to move up slowly, which we'd like to see.
Okay, I see 12 buys here when I look at the WSP Global Rating. So 12 buys and 1 hold, so a lot of people in that same boat with you. Darren, thanks for joining us. Appreciate your time.
Thank you very much. Have a good
You too. Coming up, what to expect from equity markets in 2026. More in a moment. Investors are wondering if markets can continue the bull run into 2026, or will inflation and slower economic growth spoil the party? For some answers, we spoke to Bruce Campbell, founder and portfolio manager, Stonecastle Investment Management.
We continue to see and continue to track the downward move of inflation, which of course will give the Fed more ability to lower interest rates. And I mean, there's a lot of pressure and obviously top line news today on, kind of that pressure that's being pushed from the government to the Fed. And so that's one thing we're watching. And then we also are watching a lot of the indicators that we follow. And that we have this top-down process here at Stonecastle. And we're seeing green lights in all of those indicators, including our what we call early warning indicator, which gives us a sense of where things are sort of 3 to 6 months out as well.
What's showing up in your early indicators?
Yeah, I mean, what we're seeing is just strength across the board from the market. So we track the markets on a number of different time frames, and that's one of the things that we're seeing is that strength there. So if we were to see some deterioration, what that means to us is that we generally tend to be a little bit more defensive. We tend to go a little bit bigger cap companies with a little bit lower beta, but we're not seeing that right now. So we continue to see, those areas that have been leadership in the past continue to be strong. We're also seeing a little bit of rotation though in leadership as well. So for probably the last 18 or 24 months, we've seen a lot of talk about the Mag 7. Well, now we're seeing that broadly diversifying out. And so as an example, the Russell 2000 was hitting a new high there on Friday.
It's interesting, that we've heard so much about that eventually there'll be a catch-up by these smaller stocks. And the Mag 7, it's certainly not down a lot, but it is not at record highs.
Yeah, I mean, it's just kind of going sideways here, and it probably does that. I mean, as those stocks kind of rotate. But you think about the money that's in just NVIDIA alone, if it starts to come out and rotate into other areas, there's a lot of money there that can move other stocks to new highs.
You have some stock ideas for us, starting off with one called Energia. Can you remind us what they do, Bruce, please?
Yeah, they're in renewable natural gas. And this is a really fascinating story because that was a really big trend going back a few years ago. This company came public and they got themselves probably over their skis a little bit as far as building facilities. And they almost went bankrupt. They were recapitalized, and now their focus continues to be on renewable natural gas. But instead, what they're doing is they're working with companies to build those facilities. So think about a company like Frito-Lay, for example. They have all of these facilities around the world that produce potato chips. And with that potato chip comes a lot of waste. And so what Energia is doing is they're taking that waste, turning it into renewable natural gas, which can then turn around and power those facilities. And Frito-Lay is one of their clients globally. And if you look at what they've done from a sales standpoint, they continue to ramp up their sales and get new orders and continued orders. They just turned EBITDA positive on the last quarter, which is really exciting news. And they're really not on the radar of any institutions because of the fact that they've gone through this transition and this recapitalization. And as a result, they're really starting to get more attention, and they'll show up on the radar of a lot of institutions this year.
Another stock that you do, I believe, like the look of is Lululemon. Bruce, would you be a buyer of it right now?
We don't actually like Lululemon.
Oh, I'm sorry.
It ranks,
okay.
Yeah, it ranks around 1,100 of our in our U.S. rankings of 1,900 companies. So it's fairly far down.
Oh,
what we always look for, of course, is that earnings and revenue acceleration. And right now, we haven't really seen that. It sounds from the news, though, that Lululemon's had good numbers, and so we could see a bit of a ramp up here.
But what could get you warmer on Lululemon, Bruce?
Yeah, I mean, if we saw a quarter or two more of sustained sales, then at that point in time, it rises up through our ranks because we're looking for that revenue and earnings acceleration. And then that's where we'd be more interested in looking at it for the continued ramp and acceleration.
And finally, Bruce, how are you playing gold? Are there any gold names that you like, or do you buy producers, or do you buy seniors or intermediate developer type companies?
We tend to be in the middle there. So yeah, we have some senior producers, and then we also have some intermediate producers. We don't do too much of the pure exploratory companies just because we don't have enough technical knowledge when it comes to trying to figure out whether or not those deposits are going to be productive. And also, the second thing is it takes so long now to get through that process from where they find or maybe are finding that discovery to when they actually build a mine. And it costs a lot more in a lot of cases, and it takes a lot longer. So we try to avoid those, especially in a situation like this where we're seeing, really strong cash flow improvements from the producers because their cost of production versus what's happened with the commodity over the last couple of years is such a big difference that every single dollar that adds to the price of gold or silver just falls to their bottom line.
And you are keen on the cannabis space. You've invested in it over the years. It's been a tough sector to own in many cases. Are there any names you like there right now, though, Bruce?
It still continues to be really challenging from a political standpoint, just because there's so much on again, off again news of what's happening in that sector that right now we've just stepped back. We don't have any exposure in the sector. And, we're just kind of watching and waiting. If we were to get some sort of regulatory changes in the US, then that really fell across the board and helped some of these companies. There's a lot of value there, but we just, because of the volatility and the political nature of that sector right now, we've just kind of stepped back.
Bruce Campbell, founder, portfolio manager, Stone Castle Investment Management. Coming up, the top 3 ETF trends for 2026, AI, gold, and elbows up. More in a moment. Today, Trump threatened Jerome Powell with a criminal indictment, and Bank of Canada Governor Tiff Macklem offered a staunch backing of the U.S. Federal Reserve Chair. For more, we were joined by Bipin Rai, head of ETF Alternative Strategy at BMO Global Asset Management.
We're in uncharted waters insofar as the Federal Reserve is concerned. Certainly you can point back to prior instances where we had a certain degree of palpable tension between the White House and the Federal Reserve. That's primarily a story from the 1970s. And of course, we remember that era for being notable for high levels of inflation and the like. And, that's something that a lot of investors should think about in this sort of, next era for monetary policy making in the United States. To what extent does that lead to unfavorable outcomes for the real economy?
And interesting, I thought that Tiff Macklem, the governor of the Bank of Canada, issuing a statement in support of Jay Powell. You think he must have considered, well, I'm just going to steer clear of that. It's an internal American thing.
If you look back across the last several decades, and certainly across the span of developed market economies, I mean, the Great Moderation, part of the reason why it was so successful in taming inflation was the fact that central banks made it a focus. And for central banks really to prioritize inflation and getting it down to more reasonable target levels, I mean, that requires a degree of operational independence from the fiscal side of things, and really moving away from that fiscally dominant era of monetary policy making that had been, a few countries had been subject to that in decades past. So again, this is sort of the notion of an independent central bank. It's not a U.S. specific value. This is something that's quite common across most of the developed world as well.
Now, you have some ideas, ETF ideas. They are BMO ideas, but, we'll note that, for navigating the current market. You say that there is possibly a rotation going on from AI, but one option for people who want to keep a toe in the water here would be the Canadian, the BMO Covered Call Technology ETF, ZWT. Why is that?
Right. So we feel that, if we're looking at the AI space going forward, I mean, it still makes sense to be invested in the space. And I mean, sure, you can have this sort of talk about, AI being a bubble. In fact, we would argue that, it's moving away from being a pure beta play, whereas anybody investing in the space automatically, you'd expect their shares to increase. We think there's going to be more winners and losers going forward when it comes to capital expenditures, deployment of said capital in the AI space. It's a lot of the winners and losers, and what happens going forward from here is going to be dependent on, one, how that capital expenditure is financed. Is it, again, financed endogenously from operating cash flows, or is it reliant on external debt financing? And then two, it's also going to matter what the capital structure or the makeup is for a lot of these firms. So again, there's going to be winners and losers. And in that sort of environment where, say, pure beta takes a back seat to more active strategies, we think there's room for covered call strategies that target the tech sector to potentially outperform while allowing investors to harvest a reasonably attractive yield as well.
Now, my Bloomberg screen is showing that I think this thing was launched in early 2021, and it's done pretty well. Total return of 150% in Canadian dollar terms, actually beating the NASDAQ 100. So often, you give up upside here, but it has, by my Bloomberg screen anyway, beaten the NASDAQ 100 over that period.
It has. And we can't look past the fact that we also do harvest a reasonably attractive yield as well, that it is also adding towards that the return profile for prices alone. So we do think that is also something that is important. And again, it's really the composition and the structure of that particular ETF. And that, again, we have to attribute to our top-notch portfolio management team.
Yeah, I was including the distributions there. Now, on Canada, we're going to face trouble. The Prime Minister said we were going to go elbows up, but we've backed down from a lot of the measures and dropped the digital services tax, trying to please Mr. Trump. So it could be choppy for Canadian stocks this year. You have a product, ZLSC, the BMO Long-Short Canadian Equity ETF. What's that one about?
So that's an ETF that, has done reasonably well over the past year. And that's, leveraging our abilities on the quant side to put up particular, say, frameworks or lenses with which to filter through Canadian or the universe of Canadian stocks and pick winners and losers. And again, there's...
Did we lose Bipan there, or is it me? Oh, sorry. Go on, Bipan.
I'm sorry? No, it's one of those screens where or at least one of those strategies where we tend to leverage, our intellect within BMO Global Asset Management insofar as quants are concerned, and really optimizing strategies that filter through particular screens. And again, it tends to do reasonably well during an up year for the broader index, which is something that we saw for the TSX in 2025, certainly something that we're expecting again in 2026. And again, this particular ETF should do well under those circumstances.
We're tight for time. You have another product, the BMO Covered Call Spread Gold Bullion ETF. What's the idea with this one?
Well, I mean, in this sort of backdrop where we're in this sort of space where we are a little bit leery about fixed income and the fact that it could correlate positively with equities more and more, again, if inflation remains elevated, we like holding gold as that instrument that is, a diversifier within the portfolio. It can mitigate some of the volatility. Now, of course, the long-term problem with gold is the fact that it yields nothing. So, again, if we have this covered call spread, and again, this is very different than a covered call strategy, this allows investors to participate one-to-one with the movement in gold while also harvesting in yield as well. So it does bridge that gap between something that gold has been missing as a diversifier versus traditional diversifiers like fixed income. And that's something that we think should appeal to a lot of investors in Canada.
Now, I believe you just launched that one in May of last year, Bipan. It has over that period underperformed, but of course it's been gangbusters for the gold stocks. I'm showing a total return of about 33% for that ETF since the end of May of last year, whereas the XGD, a straightforward iShares ETF, is up almost 90%. So it has lagged over that period.
It has. I mean, it's also a function of the fact that gold prices have done extremely well over the past year. Now, if you're somebody who's sitting there and worried about the fact that gold is incredibly overbought, and certainly you can make a reasonable case there. I mean, certainly, the diversification appeal of it will still remain there, but that is offset if we do see a meaningful retracement in gold prices in 2026. Something like a ZWGD should shelter investor portfolios from that, given the fact that you still do harvest an attractive yield. So again, if we're having this conversation from, say, 10 to 11 months from now, Andrew, wouldn't surprise me at all if we have ZWGD that's outperformed.
Viv Narai, head of ETF Alternative Strategy at BMO Global Asset Management. A last look at the markets before the end of the trading day. We have the TSX in record territory again, so set for another record close. It is up 0.8%, 273-point gain so far on the day. Let's have a quick look at the U.S. markets because the S&P is in record territory as well. It's at 6,978. The Dow Jones a 94-point gain right now, and the Nasdaq up 66 points, or about a third, just less than a third of a percent. Gold has been a big mover today on the market. It has broke through another record. It's up over 4,600 to 4,607 right now. And $2.37 percentage move up today. Silver also moving up today. It's a gainer. It gained 7% plus, a move of $5.84, taking it to 85.18. U.S. banks also losing today on some news by Donald Trump. We're back in a moment with the closing numbers for the day on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the Nasdaq, BlackRock ringing the bell. In New York, Riskified ringing the closing bell. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Another record close for the TSX. It moved up 261 points, 0.8%, ending the day at 32,874, beating a record of just last week. The S&P 500 gaining 11 points, but enough for a record close there as well. It ended the day 6,977, again up just 0.2%. The Nasdaq gaining 62 points today, 0.25%, ending the day at 23,733. Let's get to the movers in Toronto. Gold had a stellar run again today, pushed past 4,600. And so that took Aya Gold and Silver up. It's up $2.57 or 12% to $23.95. Energy fuels also a gainer today, 5.8% up. It's up almost 250% over the last year, ending the day today at $26.72. Lithium Americas a gainer as well. It is up 6.7% today, or almost 76% over the last year. A gain of 50 cents, taking the stock price at $7.99. Then Curaleaf, which is a cannabis company, also moving up today, gaining 8% or 28 cents. First Majestic Silver, also a gainer today. It moved up 6.6%, a gain of $1.73 per share. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now to talk some more about what's been going on. Stephanie, Washington once again stoking uncertainty, and that led to gold gaining. You tracked Aya Gold and Silver.
Yeah, that's right, Marella. What a day it's been. So Aya Gold and Silver shares gained by nearly 15% at their highest point, which brought the stock to a fresh all-time high. It was also the top TSX performer, like you alluded to, for most of the trading day today, as it had the best intraday boost since late September. And it's another one of those days in a very hectic news cycle where uncertainty is causing precious metals to climb to a new record, bringing most of the TSX-listed gold and silver names up with it. So unsurprisingly, this time, this edition is stemming from the news over the weekend where the U.S. Department of Justice is threatening the Federal Reserve with a criminal indictment, escalating President Donald Trump's attack on the central bank. That prompted gold to move above $4,600 an ounce, like you mentioned, and silver also topped $85 an ounce. So that's after Fed Chair Jerome Powell had a video statement over the weekend, basically saying that this attack comes among ongoing pressure from the administration to lower interest rates, which he said he will only do, or he will follow what the judgment that him and his team are focusing on at the time, rather than anything politically motivated. So this has been stoking concerns around the Fed's independence and eroding confidence in some U.S. markets as a place to invest. You saw that reaction early in the trading day with the S&P 500 pulling back from all-time highs before it ended up regaining its ground and getting back into the green. But it did create a bigger flows of funds into gold and silver names like Aya, like I just mentioned, and other names like First Majestic, Endeavor Silver, New Gold, and others, Marella.
Okay, you also tracked Emera Utilities Company today. What happened there?
Yeah, so a different story for Emera. Those shares fell by 3% at their lowest point, which doesn't seem like a terribly massive move, but it was its biggest intraday drop since last April. And it brought the share price down to its lowest level since late last month. And that's because a Bank of America analyst, Ross Fowler, and his team downgraded the utilities company to a neutral rating from a buy rating. Fowler mentioned that there were earnings headwinds in Canada, specifically coming from the economic and regulatory backdrop in Nova Scotia that's less attractive, creating more uncertainty for the forecast for earnings per share. That said, they added that they continue to favor the Florida operations and say that they support management's strategic focus there. And while I'm mentioning that this has been a drop for Emera, it's a minor setback considering that in the past past 12 months, Emera shares are up by about 26% since I last checked. So it's still pretty much on a solid run. It's just having a bit of a moment here, Marella.
A moment indeed. All right. Stephanie Hughes with Bloomberg. Thanks for that. Appreciate the update. Joining me for Mover South of the Border today is Bloomberg's managing editor for U.S. equities, Michael Regan. Michael, thanks for joining us today.
Oh, thanks for having me.
So Trump,
the markets did close.
Sorry to interrupt you. I wanted to start with the credit card interest rate that Donald Trump wants to lower to 10% for a year. Who got hit by the news today?
Yeah, really a broad swath of companies got hit by this desire from President Trump to lower credit card rates to a maximum of 10%. And not just credit card issuers like Capital Ones and the big banks that issue the cards, but some retailers like Macy's that issue their own store brand cards, and some of the airlines who get some profits from partnership with credit card firms. Now, analysts like Michael Mayo at Wells Fargo said in a note basically that this would ruin the economics of the credit card industry, eliminate most of their earnings for a year, and their incentives, in his opinion, then would be to simply stop lending as much as they are. So several other analysts chiming in and saying because this is such a drastic measure that they don't think it will go forward due to the strong lobbying of banks in Washington, D.C. That said, we did see Capital One Financial especially hit for about 7%. American Express down about 4% as well. Citigroup down. And as I said, Macy's and some of the airlines like Delta and United also seeing declines today off of this news.
Interesting. Yeah, you've got to put the partnerships that exist, which is casting a wider net. So Abercrombie didn't have a great Christmas season. What more did we hear from them on that?
Yeah, really quite a shocking drop for Abercrombie today. Now, this is a stock that was up about 90% from its last earnings report in November. But basically, they came out at an investor conference today and predicted earnings growth of about 5%, which is right in the midpoint of its prior range. But investors, given the run-up in the stock, really reacting negatively to the fact that they didn't offer a more optimistic forecast for the holiday season. So big drop in Abercrombie. Also, American Eagle, Urban Outfitters, and a few other mall store retailers like that also falling in the downdraft of Abercrombie today.
Okay, and Walmart joining the NASDAQ 100. Walmart wants to be seen, I guess, as more of a tech company than a retail company?
Well, yeah, Walmart shifted its listing from the New York Stock Exchange to the NASDAQ late last year. It was really the biggest ever defection from one exchange to the other. Part of the rationale, a lot of analysts said, was in order to be included in this NASDAQ 100 index, which NASDAQ confirmed on Friday, it would be replacing, who are they replacing? Replacing AstraZeneca, actually. And, you know, the reason is there's so many exchange-traded funds and other funds that benchmark to the NASDAQ 100 that this should unlock some flows from mutual funds and ETFs into the name, buying more of the shares. Jefferies estimated last month that it would prompt about $19 billion of inflows into Walmart. So we're definitely seeing a positive reaction in that stock on the news that it will be included in the NASDAQ 100.
All right, got to leave it there. Bloomberg's Michael Regan, appreciate your time. Thank you, sir.
Thank you.
Coming up next, U.S. markets rebounded, rallying from session lows despite that threat to indict Jerome Powell of the U.S. Federal Reserve. We're back in a moment. Our next guest has set a year-end target of 7,800 for the S&P and recommends a secular barbell investing approach focused on gold and AI. Let's go to Oh-Sung Kwon, Chief Equity Strategist at Wells Fargo. Thanks for joining us today.
Thanks for having me.
Let's start with the barbell. Gold has already had quite a run last year, another high today. Where do you see it going in 2026 and why?
Yeah, I think higher. I mean, I see two mega cycles that are happening in today's market. And one of them is the debasement cycle that everyone's talking about. We actually came up with a measure to gauge where we are in the fiat currency cycle. And that measure is essentially M2 money supply divided by the gold price. So it's the number of ounces of gold that the entire money supply in the economy can purchase. We went back all the way to the 1800s and found that we're in the fourth currency devaluation cycle that started in 2022, which coincided with the hiking cycle as well as Russia-Ukraine. There are three drivers of the currency cycle. It's the budget balance, so fiscal deficit, debt to GDP, and inflation, all of which are probably going to remain pretty negative, maybe except inflation, if we are actually in this disinflationary cycle. But I think the debasement cycle is likely to continue, which means that gold is likely to outperform the S&P 500. That's been the consistent trend of the four debasement cycles that we had historically.
Okay. You also think AI is worth investing in or staying invested in. Investors, as you know, have been demanding return on investment late last year. Do you think we will start to see some of that this year, or do you think most of that will come in the years later?
Yeah, I mean, the monetization side of the story is still in the question mark, right? And I think that's why people got a little too concerned about the CapEx cycle, because they're concerned that if hyperscalers are not necessarily monetizing, they're going to start cutting CapEx. I think that concern is way overdone. I think it's way too soon to call a peak in the AI CapEx cycle. I mean, I think the last thing that hyperscalers are going to do is to cut CapEx, and I think we're going to see more upside surprise when they report in a few weeks during this earnings season. And I think this is really an arms race of the hyperscalers that they kind of have to spend to stay competitive. And the market consistently underestimated their CapEx plans. And this isn't really the first time that we are seeing the changing reaction function in the equity market. The market had pushed back on CapEx outlook in 2024 as well. So I don't think that necessarily changed the outlook for CapEx going forward.
Okay. Are there some that are already doing better at providing a return on investment? Where are you seeing that?
Yeah, there are obviously winners and losers of the big four hyperscalers. And I think that's really the name of the game for that group, that it's really a stock pickers market, that it's about who's going to win this race and who's going to lose this race. I think there are going to be huge winners of the group, but also I think there are going to be huge losers of the group as well. So as a group, I don't necessarily think that group is going to outperform the market this year. We're still preferring the semis and the capex takers side of the trade rather than the capex spenders.
Okay. With this K-shaped economy everybody's been talking about, with the people who are in the upper end of that spending and the lower end not, what is the biggest concern if this continues this year?
Yeah, I mean, this has been a K-shaped economy for the past 2 years or so. And we are seeing that not just from the consumer's perspective, but from the company's perspective too, that we have seen a huge increase in productivity for the S&P 500, but since ChatGPT came out, but at the same time, we have seen actually decline in productivity for the Russell 2000. So it's really a changing landscape between have and have nots. And I think that's likely to continue unless rates fall enough to really start a new business cycle. And I don't think that's going to be 2026 story. That being said, I think the economy is still doing well, and the middle or lower income consumer that's been struggling, they're going to see the fiscal tailwind as well. Really coming from the tax returns. We estimate about $800 more per person in tax returns this year versus the year before. So that's going to be pretty stimulative to the overall economy.
Can you factor in midterms for the end of the year and what you expect from that? How will that play out this year in the markets?
Yeah, I mean, I think this creates a massive moral hazard issue, but I think neither the Fed nor the government can afford a downturn in the equity market. So first of all, U.S. equity portfolios are now a bigger portion of U.S. total household net worth than real estate. What that means is, obviously, there has been a big wealth effect in this consumption economy. And so what that means is if equities go down, that could potentially hit consumption and potentially hit the economy. So I don't think the Fed can afford a downturn in the equity market. At the same time, investment income tax, so basically capital gains tax, dividends, and interest income tax, those now represent about 25% of government revenue, tax revenue. And that's been very much tied to the S&P 500, which means if S&P goes down, government revenue is actually going to go down. And with all the fiscal concerns that we have in this country, and especially heading into the midterm, I don't think the government can afford a downturn in equity either. So I think there's the government put as well as the Fed put heading into the midterms this year.
Okay, Oh-Sung Kwon, I got to leave it there. So thanks for your time. Oh-Sung is Chief Equity Strategist, Wells Fargo. Coming up next, Paramount suing Warner Brothers now. More on that in just a moment. Paramount is suing Warner Brothers and looking for details about that deal with Netflix. The David Ellison-led streaming giant also plans to nominate directors to Warner's board at the annual meeting. Let's talk about this with Jeff Barrett. He's general partner at Barrett Capital Holdings. Jeff, walk us through this a little bit. Paramount is suing Warner Brothers, but on what grounds?
Yeah, so look, this is part of what would be an eventual proxy fight. And so the idea here, they're suing them in Delaware court to get further information on the Netflix bid that they can share with shareholders. And the idea would be, as a next step, that they would try to block a shareholder vote on the next Netflix deal until shareholders had a chance to vote on the Paramount deal. And so, that's one path. And what could change in that path is they enter into some sort of negotiation with the Warner Brothers board on a revised deal, which may be a higher price for the whole company or parts of the company. and then maybe split up. But the idea is they're ultimately trying to block a vote on the Netflix deal because Paramount feels their bid is superior to the Netflix deal. And I'm happy to talk to that.
Yeah, we'll talk about that in a moment. But as part of it, Paramount wants to get its own slate of board members in. How easy is that to do? And does that eventually get them to the negotiation that it looks like they want?
Yeah, look, it is. Look, to the extent that shareholders are upset, I don't think the bids are that far apart. So I think Paramount, in order to have success in a proxy battle, would have to bid, frankly, a higher price. And I think that they're not, I think they're prepared to do that. And so the idea would be you call a special meeting or you do it at the general meeting and you put a slate of board members up, shareholders vote on that. That puts your own board members in place, and then they have the right to negotiate with Paramount. That's extreme. If it got that far, I'd be surprised. I think it's positioning, and I ultimately think that there's a higher bid here coming. I think if you listen to the comments that the chairman for Warner Brothers has said he says there's a path for Paramount to get this. And so I think it's not just the price, but that certainly is one. And so, people value Netflix at their bid at 31 and Paramount's at 30. We can argue that. So it's probably got to be at least 33, taking into account the break fee. But I also think there's some uncertainty on how committed the debt financing is for Paramount's bid. And the debt financing's high. It's, $54 billion or something. And I would actually put up something that I think is a good alternative that Paramount could use. QXO, which is a company I follow, I mentioned it to you on the air, they just did a $3 billion preferred financing, which is effectively a financing commitment. And shareholders agreed it very well. And I think Paramount could do something like that to help the board with their comfort on the financing. But I'd also say, look, David Zaslav's behind this. He's the CEO of Warner Brothers. He's very incentivized to get a high price. At $10, Zaslav basically had his options at zero, and he had 11 million in shares. And now, his options are worth, and stock are worth 600 million from that. So he's done very well off of this. And he's, I think, a very good negotiator. And I think he's playing Ellison Jr. on this in an extreme way. And it's ultimately going to be the right thing for Warner Brothers shareholders.
Let me ask you.
So that's how I see it coming together.
Between the two, Jeff, which deal would face more regulatory scrutiny, Netflix or Paramount?
Yeah, look, I think the natural gut reaction is Paramount wouldn't face that much regulatory scrutiny. I think the Netflix one isn't that bad because what they're doing is spinning off CNN and some of the more controversial stations into a stubco, so they wouldn't control that. I think Paramount's closer to the president, so all else being equal, I think he would favor a Paramount bid, but he hasn't made negative comments on the Netflix bid. So I'm actually not that worried about it. I know others are, but I'm actually not that worried about it.
Has a date been set for a vote on the Netflix offer?
No, it hasn't. So we think it's spring at the earliest and maybe August at the latest. So we're waiting for that.
Okay, so a lot still to unravel with this particular go-about. Jeff Barrett, sir, thanks for joining us. Appreciate it.
Yeah, no, it's always a pleasure. Thank you.
Coming up next, the big banks in the U.S. are reporting earnings this week, and we are uncovering what to expect when we come back. Here are the stories we are following in the newsroom today. Citigroup planning a round of layoffs this week. The Wall Street Bank is set to cut about 1,000 jobs, part of its plan to trim costs and improve returns. The city announced plans 2 years ago to cut 20,000 jobs by the end of this year. The bank has been undergoing a revamp that has included exiting much of its international retail business and restructuring core operations. There are reports Meta is planning to cut around 10% of staff in its Reality Labs division. The layoffs to be announced this week and would affect the metaverse. Last year, the CEO, Mark Zuckerberg, asked top executives to make cuts to their 2026 budgets. The company also plans to reallocate some of the money from virtual reality products to increase the budget for its wearables division. And Statistics Canada planning to reduce its workforce. CTV has learned the agency will cut 100 positions this week, with that number expanding to 850 over the next 2 years. As part of the cuts, executive positions will also be reduced by 12%. StatsCan will also end most acting appointments by March 25th. Earnings for the big American banks come out later this week. What can we expect? Let's unpack with Gerard Cassidy, Managing Director and Co-Head of Global Financials Research. Thanks for joining us today.
You're very welcome. Thank you.
Let's look back for a moment. What boosted the sector in 2025? Where did it gain?
Very good question. Since the bank index, the S&P 500 bank index was up 30%, far outperforming the S&P 500 in 2025, and for that matter, in 2024 as well. And the reason that you saw such strong performance in 2025 was driven by the large cap bank stocks. And within those names, the capital markets businesses were very strong in 2025 against expectations at the beginning of the year, as well as the wealth management businesses. But I also overlaying on that, and Morello will go into 2026 as well, is the whole deregulation approach to banking that this administration is taking. And that's going to lead to, we think, structural higher profitability for the banks in 2026 and 2027.
Okay, I want to talk about that in a moment, but I also want to get your reaction to this now desire from the president to cap credit card interest rates at 10% for a year, and he wants that to take effect later this month. How much of a hit could this be for banks and other financials? We saw them slide today.
Sure, no, they certainly did trade off on this uncertainty. As for an executive order, which is what the president is talking about, there really doesn't have much, weight on actually having the banks change their interest rates on credit cards. For that to happen, it either has to come through a congressional legislation like the Credit Card Act of 2009, or it has to come through regulators codifying regulations, which we don't expect. So this is, we believe, political posturing. We can understand why it's being done, but it does create uncertainty. But if it was to go through, it would certainly have an impact, particularly for the credit card companies that have the higher yielding credit cards on their books, which have greater risk associated with them with lower quality borrowers. Whereas a lot of the commercial banks have higher quality borrowers. The yields on their portfolios are not as high as the credit card companies, so the impact to them would not be as big, but it still would be disruptive to consumer borrowing and consumer spending, because the banks, if forced to do this through a legislative law or codified regulations from the bank regulators, they would have to underwrite their books of business, and there would be a number of consumers that would not have access to credit if that rate was lowered to 10%.
Okay, I do want to get to regulation again in a minute, but we also see banks beginning to benefit from AI, right? The back office has been taken over by some of this AI. You expect that to ramp up this year and that provide a lot of savings for them?
Yes, I would say that, across the board, the banking industry is adopting AI. Like all technologies, whether you turn back the clock for a moment, and let's think about what happened in 2007 and 2008, aside from the financial crisis, of course, but the introduction of the Apple iPhone. And digital banking was launched, and it's very powerful today. It has improved efficiencies, but all the banks have it. And I would say that's the same with AI, that you're going to see a continued benefit from technology spending, and it should improve productivity. We're not convinced yet that it's going to lead to higher profitability, but yes, it is important. It's table stakes. Banks are spending billions of dollars to make sure that they have capable AI support, and I think you'll see over the years, it's not imminent in the next 3 to 6 months, but over the next 3 to 4 years, it's going to have a real impact on the banking industry.
Okay, you mentioned deregulation, which this administration is very focused on. Can you give me an example of a regulation change that will really help the financial sector?
Very good question, Morella. And I would say that there's a couple. The big one that's coming, which is not out yet, is the so-called Basel III Endgame proposal. We expect that the first quarter of 26. And I would say that what you're going to see there is that this will lower the amount of capital that the banks have to carry relative to the first proposal that came out in the summer of 23, which was going to boost the capital levels of many of the banks. Many of the banks went ahead and started to build up capital, and now there's this excess that's there, and when that will be given back to shareholders in the forms of increased buybacks in 2026, in our opinion. But specifically to your question, if we look at what happened in November, the controller of the currency and the FDIC have done away with some of the restrictions on what we call leverage lending. So these are loans to highly levered companies, and there was restrictions where banks could not make the loan if the loan ended up being 6 times the debt of the company was 6 times EBITDA, or if the company could not pay back half of the loan in a 3 to 5 year time period after the loan was made. So those restrictions have been pushed out, or they're no longer applicable. So now the banks can compete with private credit more effectively, and I think you'll see better loan growth as a result of that. Longer term, though, when we go through a credit cycle, these loans are more vulnerable to have credit issues if we get into the down leg of our credit cycle at some point in the future.
Yeah, so 2 very big changes just outlined. All right, Gerard Cassidy, got to leave it there. Thanks for your time. Appreciate it.
You're very welcome. Thank you.
Straight ahead, we're looking at the upswing in art sales and what is spurring it. Back in a moment. Art sales are rebounding at major auction houses like Christie's and Sotheby's. Industry insiders are calling it a comeback for the art market. For more on what's driving the surge, we're joined by Barbara Guggenheim, CEO of Barbara Guggenheim Associates.
It's a good time to buy. It's a good time to look at established artists who've been overlooked in the past or have been right in front of our eyes, but everyone's been looking at younger artists. So it's a great time to focus.
And who are some of those artists?
Whether, if you like Picasso, whether it's a Picasso painting or you can afford a Picasso print or a Warhol painting or Warhol print, the rule now is to buy the best of what you can buy.
Hi, Barbara. It's Paul Harris speaking. I'm just wondering, is the demographic of the art buyers changing over the last little while? Or are they sort of the similar kind of wealthy individuals around the world, or are they kind of is that demographic changed over the last, let's say, few years?
Well, I think what happened is a lot of people got into the market because they thought it was a get-rich-quick scheme. And the prices went up and up and up for artists. You would go to an auction. If you couldn't get one privately, you'd bid whatever you needed to bid because you had $1 million and someone else had $1 million and you wanted that painting. And then when the works got over $2, $3, $4 million, it kind of fell off a cliff. And people have now turned to more established artists, and they're looking for opportunity in quality.
And I mean, timing, like everything, timing the market is so important. And you mentioned about quality. Are there some genres or spaces that maybe people might not consider looking, but might be worth taking a look?
I think the best thing is always to work with an advisor. Of course, I'd say that I am one, but there are tons of areas of opportunity. For example, there was a big surrealist sale. The Latin American painting by Frida Kahlo brought a lot of money. The Klimt brought a lot of money. So across the board, there are opportunities. And I think what came out was a lot of material that hadn't been on the market in a very long time. And so fresh material attracts collectors because collectors collect. That's what they do. And they wait for opportunities.
So, Barbara, I guess one of the issues is that when you hear about the art market and you're going to hear about Christie's and Sotheby's and sort of the main things they sold. So, and that's wonderful if, Picasso or something that goes for millions of dollars, hundreds of millions of dollars, I guess. But is the market really supported by kind of paintings that are in the $1, $2, $3, $4 million range? Is that the way the market works? Or is it really these big things that make up most of the market?
No, I think you're right. I think it's the middle range market. But you have to really be aware and really study. For example, there was a Stuart Davis that came up in the Pritzker sale that brought $1.5 million. 2 or 3 years ago, it would have been a $5 million painting. So whoever bought that got a bargain. That is, if Stuart Davis comes back in price. It may be the kind of pump and move on for certain artists. It's very hard to tell.
And now you also say you're seeing younger people get involved. Are they buying big like that, or are they starting out in a different category, and what are they looking at?
I think that like anything on this table is $150,000. It's very hard to find a young artist for $10,000, $20,000, $30,000 who can give you a guarantee that that's going to be worth more. So I have a client, for example, who said, don't bother me unless it's $250,000. And there are a lot of collectors already in on it, because then I'm kind of sure that a village is surrounding and pushing the material.
So when you think about your clients, do you think of art as a sort of a part of a portfolio of, I mean, it's an aesthetic. I don't want to demean it as something like as a portfolio, but do you think of it as an investment portfolio that you add along with stocks and bonds and other aspects of investing, alternative assets? Do you think of it that way? Or, I mean, obviously you want to look at something and say it's beautiful and you like it, and I want to put it in my house because I enjoy looking at it every day. But do you think about it that way when you're advising your clients?
Well, I hope you can have both. I had a client who came to me with his pie chart from, I think, Goldman Sachs and said, I like my pie. You're going to have to explain to me why I need to change it. And he went on to be a big collector because he found artists that went up in price enormously.
Barbara Guggenheim is CEO of Barbara Guggenheim Associates. Interprovincial trade barriers could be one reason Atlantic Canada residents are seeing higher grocery costs. CTV's Paul Hollingsworth has more on that.
A father of 4 and a busy shopper, Jean-Marc Leblanc has noticed shrinkflation is now part of his shopping routine. Smaller packaging at higher prices.
I'm spending $6 for that when it's maybe 33% less of a quantity.
Based on year-over-year price changes for food products across all Canadian provinces, New Brunswick had the highest increase at 3.7%. Nova Scotia was the lowest at 2.7%. The national average across the 10 provinces and 3 territories was 3.4%.
I've noticed a steady increase.
Dalhousie University professor and food distribution researcher Sylvain Charlebois says the drop in gas prices have lowered the cost cost of transporting food, which brings a positive effect in remote areas like Nova Scotia more than other provinces. Federal and provincial tax cuts and the GST holiday cut into food inflation rates depending on the province.
Our break was like 14%, and in New Brunswick it was 15%, I believe, and in Ontario as well. But most provinces, the break was only 5%.
According to Charlebois, one of the biggest challenges for regions like Atlantic Canada are interprovincial trade barriers that have a direct impact on transportation costs and the overall price of food. In all provinces, the price of grapes, berries, coffee, and ground beef are going up on a monthly basis, which makes this shopper skeptical when it comes to receiving good news related to inflation.
Can you believe anything these days?
He anticipates prices to climb even higher and will continue to be a selective shopper searching for the best bargains. Paul Hollingsworth, CTV News, Fall River, Nova Scotia.
Coming up, hot picks in oil and gas, including a pick that is well hedged while also providing a high dividend. More in a moment. Time now for Hot Picks. We zeroed in on 3 plays in the oil and gas sector, and we were joined by Aaron Bilkoski, analyst at TD Cowen. We kick things off with Peyto Exploration as his top pick.
There's been an incredible amount of geopolitical uncertainty this year. This has created a ton of volatility. What I wanted to focus on today are a few names that are defensive to that global macro environment and have catalysts coming. Peyto absolutely checks that box. Peyto is a high-quality natural gas.
Sorry to cut you off there, Aaron. Yeah, I think you were going to say this, but they're a classic natural gas play in Canada.
Absolutely. 90% gas. They have assets in the Alberta Deep Basin. Peyto's momentum as a company really started to accelerate in 2023 when it acquired the conventional assets of Repsol. This was pivotal because these assets were very undercapitalized, and Peyto, being a high-quality, competent operator, applied its own field practices to these properties. And we're now seeing the benefits of that. The company has significantly increased the average well productivity on these areas and has driven costs down. And there's a few things that make Peyto really special in its class. It has the lowest corporate capital costs. It has the lowest corporate average gas expenses. Despite the fact it's primarily a dry gas producer, it has the highest full cycle cash margins when compared to its peers. And they have excess infrastructure. So they have twice the natural gas processing plant capacity that they need today. So while many of its peers are going out and spending capital on natural gas plants to grow, they already own these facilities. They simply optimize and fill what they already have. This means the business is generating significant free cash flow that's being redirected to single-digit growth, about 9% year over year, and a 6% dividend yield. Its cash flow is very stable, as you alluded to in your intro comments. It's about half hedged this year at a gas price at about $4. And as those hedges roll off the books, they should be rolling into a higher than current Canadian natural gas price environment as LNG Canada continues to ramp up. And hopefully as we start to see other projects come on stream, whether that's Cedar, Woodfibre, LNG Canada Phase 2, or Salisms.
Let's move on to your next name, ARC Resources. They too are well known for gas exposure. What draws you to that stock?
Yeah, so I think ARC is one of these classic examples where the market has overreacted to a relatively small disappointment in the field. So the background here is that ARC has been building out a new area called Attachie over the last couple of years. It was supposed to ramp up to about 40,000 BOE a day. Unfortunately, it's been tracking about 30,000 BOE a day. Quite honestly, it's been an uncharacteristic hiccup for a really high-quality operator, ARC. But I think we need to put that hiccup into the context of the broader business. ARC's producing over 400,000 BOE a day. We're talking about a shortfall of less than 2% of the company's production. Yet its share price has underperformed its peers by 30% since these challenges came to light mid last year. It doesn't change what makes ARC differentiated or special. ARC is the single largest Montney pure play in Canada. It is the single largest Canadian condensate producer. They're the only Canadian independent with a direct supply agreement to LNG Canada. Plus, they've signed a basket of future LNG deals with Cedar LNG here in Canada and Cheniere in the Gulf Coast. So as I look ahead, I see a share price that's well supported by healthy free cash flow. At current pricing, they're paying a 3.5% dividend yield. They can repurchase about 2% of their shares outstanding with excess free cash flow this year. While we wait for more data points that show improvement at Attachie, or the market to more rationally price in the small challenge at Attachie, and as I expect Canadian natural gas price fundamentals to improve as LNG Canada continues to ramp up.
Attachie is what? It's a crucial price setting point for gas?
No, Attachie is a Montney area in BC. It's a condensate-weighted Montney area that they've been building out for a couple of years now.
Can we move on finally to Prairie Sky Royalty, where we're looking at a yield of about 4%. Is that one of the things that attracts you here?
It's one of the things, but I think bigger picture, owning energy assets through royalty entities is a fantastic option. This is essentially the same way governments around the world receive value from their oil and gas resources. So in its simplest form, Prairie Sky owns mineral interests across about 20 million acres of land. A large portion of that is held in perpetuity, and it's Prairie Sky's job to lease out that land to oil and gas companies who do all the field work and assume the risk. So Prairie Sky simply takes a portion of the production on its lands. This means, unlike traditional oil and gas companies, Prairie Sky has no reoccurring capital expenses, no operating costs, no transportation expenses, no end-of-life abandonment expenses. Outside a small amount of G&A and corporate cash tax, all the revenue they collect is free cash flow that's used to pay dividends, buy back stock, or make tuck-in acquisitions. So despite all those benefits relative to a traditional E&P, Prairie Sky currently trades at a free cash flow yield of about 5.5%. That's better value than the Canadian Integrateds or the Canadian conventional E&Ps, which trade down to about 5%. Personally, I think this is just a fundamental mispricing of risk. So from a shareholder's perspective, you're right. You're getting roughly a 4% yield, but also they're growing the business about 4% year over year without investing any of their own capital.
Aaron Belkowski, analyst at TD Cowen. A new study shows thousands of restaurants in Canada have closed, with more to follow in 2026. The study is done out of Dalhousie University. It shows more than 4,000 restaurants are at risk this year. CTV's Kimberly Johnson reports.
Al's Diner has been serving up breakfast for 36 years. Over that time, owner Al Ayoub says his industry has seen challenges, and right now is a tough time.
Your bottom line gets smaller and smaller. You want to raise your prices, so you take a chance and scare people away. I'm not one to do that.
He says increasing food prices and wages are his biggest expenses. To keep costs down, Ayoub shops around and says owning his building has helped a lot. With plenty of dedicated customers, Al's Diner is not at risk of closing. But a new study suggests thousands of other restaurants could be forced to close this year.
I feel sorry for the ones that can't adapt to it. There's a lot of restaurants out there that are struggling and having a hard time.
A new study from Dalhousie University shows that more than 4,000 restaurants in Canada are projected to close this year. That's after 7,000 bistros, cafes, and eateries shut their doors in 2025.
And what we're seeing right now are consumers under tremendous financial pressure. They're having a hard time buying food at the grocery store, so they're not spending as much time in food service.
Restaurants Canada says other major costs for establishments include rent and insurance. It says 41% of restaurants are operating at a loss or barely breaking even, but are working to keep costs low because they know customers are budgeting. As costs mount, some customers say they plan on making changes.
I probably plan on eating out less. It's gotten really expensive. It's nice to go once in a while, though.
I would say probably about the same, but spending less. Looking for cafes rather than full restaurants, looking for snacks rather than full meals.
Kimberly Johnson, CTV News, Ottawa.
And this just coming into the newsroom. The American president posting online that a tariff on any country that trades with Iran will be in place. Effective immediately, any country doing business with the Islamic Republic of Iran will pay a tariff of 25% on any and all business being done with the U.S. Or United States of America. The order is final and conclusive. Not sure what triggered this. There has been, of course, a lot of chaos in Iran for the past few days, streets taken over by demonstrators who want an end to the Islamic regime there. We'll keep a watch on this story and update you as we get information into the newsroom. Thanks for joining us today on The Close. We'll see you tomorrow.